And as we keep saying, this has been a year like no other. Let's talk about what our next guest is expecting on markets, from inflation expectations to being bullish on Australian equities. There's certainly a lot to chew over for Grant Patterson from Providence Wealth, and that's based right here in Barangaroo. Grant, welcome to Ausbiz.
Thanks, Gemma. Hi, David.
So much to get through. I think I might just start with what we mentioned in the intro about inflation expectations. Now, they just bumped along at rock bottom for so long, but it feels like they've got a little bit of wind underneath them in the last couple of weeks.
Well, there's certainly a lot more dialogue going on in investment committees around the globe about the rebound in global economic recovery and what that means for inflation. I mean, we've had $22 trillion of fiscal and monetary support into the system that's sitting there that hasn't actually gained any traction or velocity yet.
Over what period is that 22 trillion?
That's been since COVID, so that's only in the last little while. So it's a huge amount of money sitting out there. That's why asset prices are being supported. We've certainly seen inflation in asset prices, but not in the underlying economy. So there's a lot of talk out there about when inflation is likely to come through. Central banks are certainly going to err on the cautious side, allow inflation to go above their target. So once a bit of velocity comes in, then markets will be focusing on inflation. We think at this stage it's too early. I know one of our investment committee members, Jonathan Payne, is quite concerned about inflation coming through higher and sooner than people expect. So we're watching it very closely.
Certainly a lot of inflationary pressures building in that industrial space. That's probably an article to keep on. Grant, I want to go and talk about relativities when it comes to different markets. Now, since the GFC, we've had basically dominated by funds flowing to US markets, particularly the big cap tech stocks there. Now we're at a different cycle. We're at the start of a new economic cycle. Which opportunities does it open up? Because a lot of people are looking for value markets in particular. Australia's ASX is one, Japan is another. Do you like those markets?
Yes, we do. I mean, we're looking for markets that will give us some exposure to the cyclical recovery next year and the year beyond. And one market for sure that's been forgotten for a long period of time is the Japanese equity market. So the Japanese companies are very leveraged to a global economic cyclical recovery. There's been some major regulatory changes in Japan whereby the government has focused companies more on shareholder returns, and so we're starting to see an increase in dividends coming out of Japanese companies and much better corporate governance. So Japan is a market that we think looks quite attractive over the next 12 to 18 months, and we will be deploying some capital on behalf of our clients to that market. Australia also looks relatively good shape from the economic point of view. I mean, the fiscal response has been very solid. We've been able to get under control in regards to COVID. You've had the domestic tourism area booming. Our trade surplus is at record levels. And the rural side, income side's going quite well, let alone the recovery in the housing cycle. So I think Australia's going to be a bit of a standout in regards to the economic rebound going forward. And so, some of the Australian companies I think are going to benefit quite positively in that regard.
Grant, there's been a lot of bearishness recently surrounding the US economy, not helped by the negative economic news out this week. Are we now too negative? We're looking at the US dollar, it's just continuing to dive.
Well, the US dollar tends to fall when equity markets and when global markets are quite strong, because you don't go to American dollars for safe haven. So it's a perverse sort of interaction in that regard. I think, there were strong rebounds in the US economy pre this third wave, that's come through. And you're starting to see global leading indicators just ticking down, both in Europe and both in the US. And I think that's because of these renewed lockdowns. So, and most of the cautiousness is really short term until the vaccine starts getting utilised. So, we may have some weakness over the next little while. And of course, markets are at pretty overbought, we would argue. So having a consolidation or a correction from these levels would not surprise, and we'd be just being a bit cautious going into the end of the year. But we think halfway through next year, economies will rebound quite strongly.
Do you think one of the biggest risks is just complacency? Because there's been so many different metrics out there. We were talking with Jonathan Payne yesterday about a particular metric from Citi showing the Euphoria pessimism index, and Euphoria was at the highest level, the absolute peak that we saw during the .com bubble in the early 2000s. everyone seems to have a pretty bullish thesis about next year. Is that a risk in itself?
Oh, I think so. I mean, I was looking at a statistic today, you know, out of the big losers in companies in the States that are losing money, there's $1 trillion of market cap, and those companies are losing $17 billion a year. So I just don't get that. I think the markets are too euphoric. I do understand the thesis behind the growth in tech stocks and where we've seen. I think you've got to be very careful where you are. I mean, we've seen Airbnb listed at an extraordinary number. So I've been in markets for 40 years. I was around dot-com boom and bust. I was around in 1987. I think it's really important to be careful where you are. So I think the index, or I think markets, will be well supported by the money that's flowing around from central banks. But I think there'll be a big divergence between stocks and markets and economies as we go forward. And so the most important thing is to make sure you're happy to own that asset if there is a downturn.
Oh, what a fund manager's dream to have a bit of influence. Before I let you go, because we are going to have to finish up very soon, but just wanted to ask about A-REITs. A good result last month for many asset classes, no less A-REITs.
Yeah, I think the last time I was here, I was saying we were pretty confident about having a look at retail REITs because of them being sold off so far, and they got down to levels whereby you're basically buying land value in the shopping centres. So there's a lot of bad news built into that. And then we had an extraordinary rally. One of the funds that we used was up 18% for the month, you know, which is beyond what we thought. It was much quicker than we thought. So I still think that there is value in some of the A-REITs. I do like the retail shopping areas because they're unloved at the moment. But you'd expect some sort of consolidation after such a strong run in November.
Grant Patterson, thank you so much for your time and your thoughts today. All very interesting views. A lot for us to chew over.
Thanks for having me.
As we head into the weekend.